Everyone is watching China reduce its U.S. Treasury exposure. Everyone is arguing about the dollar. And everyone assumes this is a financial story about bonds, currencies, and geopolitics. It isn't. As of February 10, China's official treasury holdings have fallen to roughly $680 billion, down from about $1.32 trillion at the 2013 peak, the lowest level since the global financial crisis. That sounds dramatic, but this move has very little to do with attacking the dollar or crashing treasuries, and it has nothing to do with trying to shock global markets. What's actually happening is more structural and far more important. When an economy slows, money doesn't disappear. It moves. It moves away from paper promises and into things the system cannot function without. This is what happens when growth weakens but demand does not. When governments can no longer rely on consumers, leverage, and speculation to carry the cycle forward. In that environment, capital stops chasing yield and starts securing inputs. Power generation, electrical grids, data centers, AI infrastructure, energy storage, these are not optional systems, and they cannot be scaled without physical materials. And right at the center of all of them sits a metal that almost nobody is focused on. While treasuries dominate headlines and the dollar grabs attention, silver remains priced as if nothing has changed, even as industrial usage continues to rise and supply growth remains constrained. So before you worry about what China is selling, ask a better question. What are they preparing to need next? Because while markets argue over paper assets, the real positioning always happens quietly, in the inputs that keep the system running. If you want to understand where this is heading, don't watch the headlines, watch the flow of materials, watch availability instead of price, and stay with me, because the silver story is only just beginning. The biggest mistake people are making right now is assuming China's move is aggressive or external. It isn't. China isn't selling treasuries because it wants to hurt the U.S. dollar. And it's not doing this because it suddenly believes U.S. debt is unsafe. In fact, if you look at the data as of February 10, U.S. Treasuries remain one of the most liquid and stable markets in the world, and Chinese banks themselves continue to hold hundreds of billions of dollars in dollar-denominated bonds. If this were a true dump, yields would already be spiking uncontrollably. They aren't. What Beijing is actually responding to is internal pressure. China's economy is slowing faster than official numbers suggest. Manufacturing PMIs remain below expansion levels, property stress has not been resolved, and credit growth continues to weaken despite repeated liquidity injections. The People's Bank of China has been forced into a corner. Cutting rates aggressively risks collapsing the yuan and triggering capital flight, but doing nothing risks deepening a recession. So instead of acting directly, Beijing is using guidance, optics, and narrative control. By framing U.S. treasuries as a concentration risk, regulators create a justification for banks to rebalance without signaling panic. This isn't about selling bonds into the open market. It's about redirecting capital back into domestic assets, particularly Chinese government bonds, in an attempt to push local yields lower and stimulate activity. In other words, this is not a vote against treasuries. It's a defensive move to manage a weakening domestic economy without pulling the rate cut trigger. Here's the irony almost no one is talking about. Chinese banks actually prefer holding bonds in a slowing environment. As growth weakens, interest rates tend to fall, and falling rates increase bond prices. That's why leverage in China's repo market has surged, with overnight and short-term borrowing reaching record levels in recent weeks. Banks are positioning for lower yields, not higher ones. That alone should tell you this isn't about fear of U.S. debt collapsing. So when you hear that Beijing is telling banks to reduce treasury exposure, don't interpret it as an attack on the dollar. Interpret it as a signal that China sees prolonged economic weakness ahead and is trying to manage it quietly. This is about control, not confrontation. And once you understand that, the story stops being about bonds altogether and starts being about what economies turn to when financial tools lose their effectiveness. Stay with me, because this is where silver begins to matter far more than treasuries ever will. When financial tools stop working, economies don't slow evenly. They shift. Credit loses its ability to stimulate, rate cuts become dangerous, and currencies become politically sensitive. At that point, growth doesn't come from confidence or consumption anymore. It comes from construction, electrification, and state-directed investment. This is the phase China is entering now, and it's the reason this story quietly stops being about treasuries and starts becoming about materials. China cannot afford a consumer-led recovery, and it cannot rely on property the way it once did. What it can still do is build power grids, data centers, AI infrastructure, electric vehicles, solar capacity, storage systems. These are capital-intensive projects that governments can push forward even in weak economic conditions. And every one of them shares the same bottleneck: physical inputs that cannot be printed, delayed indefinitely, or substituted easily. This is where silver comes in, and why it matters far more than most investors realize. Silver is not behaving like a monetary metal right now because it is increasingly an industrial one. As of February 10, global silver demand remains heavily skewed toward industrial usage, with electronics, solar, EVs, and grid applications accounting for well over half of annual consumption. At the same time, mine supply growth has stagnated, recycling has failed to meaningfully accelerate, and above-ground inventories have continued to tighten quietly in the background. The key point is this: industrial buyers do not care about spot price volatility. They care about availability. They do not wait for confirmation, and they do not announce their intentions. When silver is needed for production, it is acquired through long-term contracts, off-market deals, and supply chain arrangements that never show up in headlines. By the time price reacts, the material has already been spoken for. This creates a dangerous disconnect. On screens, silver still looks like a speculative asset, moving up and down with sentiment, rates, and paper positioning. In the real economy, it is increasingly treated as a strategic input. That disconnect can persist for a long time, and then close very quickly. And when it closes, it does not do so politely or gradually. So, while the market debates whether China is selling treasuries or attacking the dollar, the more important question is whether enough silver exists to support the next phase of industrial expansion. Because once financial stimulus stops working, governments don't turn to promises, they turn to materials, and silver sits directly in that path. In the next part, we need to address the contradiction that confuses most people right now. If silver is so critical, why does it still look ignored, under-owned, and mispriced? This is where most people get confused, because everything about silver looks wrong on the surface. If silver is so critical to modern infrastructure, if industrial demand is rising, and if supply is constrained, then why doesn't the price reflect that? Why does silver still trade like a forgotten asset while capital crowds into everything else? The answer is not lack of demand. It's the structure of the market itself. Silver is one of the few commodities where the paper market completely dominates price discovery. Futures, ETFs, and leverage positioning set the visible price, while the physical market operates quietly in the background. As of February 10, daily paper volume in silver still dwarfs the amount of physical metal that actually changes hands. That creates the illusion of abundance, even as physical flows tighten. On a screen, silver looks liquid. In reality, much of the available metal is already committed. At the same time, retail behavior has shifted in a way that masks what's happening underneath. Buyers chase products with premiums and headlines, while large industrial users secure supply through contracts that never touch the open market. Dealers widen spreads not because demand is weak, but because replacement risk is rising. When it becomes harder to restock, prices don't immediately spike, spreads do. That's not bearish. It's defensive behavior. Another factor keeping silver quiet is timing. Industrial demand doesn't surge all at once. It ramps steadily, project by project, grid by grid, factory by factory. That slow accumulation doesn't trigger alarms until it collides with a supply shock, a policy shift, or a sudden increase in capital spending. Silver doesn't front-run these moments the way equities do. It reacts late, and then violently. This is why silver can look ignored right up until it isn't. The market isn't pricing future necessity. It's pricing current comfort. As long as supply chains appear functional and paper liquidity remains high, the price can stay suppressed. But the moment availability becomes uncertain, the pricing mechanism changes entirely. At that point, silver stops trading like a financial asset and starts trading like what it actually is, a required input with no substitute. So the question isn't why silver hasn't moved yet. The real question is how long the disconnect between paper pricing and physical necessity can persist. Because history shows that when this gap closes, it doesn't close gradually. It snaps. Next, we need to look at what actually breaks that illusion and why the trigger rarely comes from the silver market itself. What finally breaks that illusion is never a silver headline. It's never a silver shortage announcement or a sudden surge in retail buying. The trigger almost always comes from somewhere else. A policy decision, a supply chain disruption, a surge in infrastructure spending, or a geopolitical constraint that forces governments and corporations to secure inputs faster than the market expects. This is why silver moves the way it does. It stays quiet while pressure builds off-screen, then reacts only after availability becomes the concern instead of price. By the time the market notices, the metal is no longer flowing freely. Contracts are locked, inventories are spoken for, and marginal supply disappears. That's when paper pricing loses control. because futures markets can only price what can actually be delivered. We're already seeing early signs of this stress. Industrial demand continues to grow, especially from energy transition projects and data infrastructure, while mine supply remains largely flat. New silver production is slow, capital-intensive, and increasingly dependent on byproduct mining rather than primary silver projects. That means supply cannot respond quickly, even if prices rise. Recycling helps at the margin, but it cannot scale fast enough to offset sustained industrial pull. This is the critical asymmetry most people miss. Demand can increase incrementally and invisibly, but supply cannot. When the balance finally tips, it does so abruptly. And because silver sits at the intersection of technology, energy, and electrification, it doesn't need speculative interest to move. It only needs one sector to prioritize security over price. That's why focusing on daily spot prices misses the point. Price is a lagging signal. Availability is the leading one. The moment silver becomes something buyers worry about obtaining rather than timing, the entire market structure changes. And when that happens, the move is not driven by excitement. It's driven by necessity. In the final part, we need to bring this full circle, what this means for positioning, what to watch instead of price, and why silver behaves very differently from gold when systems start to strain. This is where silver begins to separate itself from gold in a meaningful way. Gold reacts to fear, confidence, and trust in the monetary system. It moves when people question currencies, central banks, and debt. Silver doesn't wait for that moment. Silver moves when systems are forced to operate, regardless of confidence. One protects W. That distinction matters because in periods of strain, governments can delay monetary reform, manage narratives, and smooth volatility in financial markets. What they cannot do is pause electrification, data expansion, or infrastructure maintenance. Power grids still need to be upgraded. Data centers still need to be built. Energy still needs to move. And silver sits inside all of those processes, quietly and non-negotiably. This is why silver often looks disconnected right up until the moment it isn't. Gold tends to move first because it reflects sentiment. Silver moves later because it reflects constraint. By the time silver reacts, something physical has already tightened. That's also why its moves tend to be sharper and less orderly. When silver reprices, it's not responding to belief. It's responding to necessity. For anyone watching this unfold, the mistake is treating silver like a trade or a headline-driven asset. The more useful lens is to watch behavior instead of price. Watch where governments allocate capital. Watch which projects continue despite slowing growth. Watch supply chains, export controls, and strategic stockpiling. Those signals appear long before price does. At that point, the silver story no longer depends on China, Treasuries, or the dollar. Those were simply the early signals that financial levers are losing effectiveness. Once that happens, the focus shifts to what keeps systems running, and silver sits directly in that path. All that's left now is to pull the frame back and explain what this means going forward, not as a prediction, but as a reality the market eventually has to reconcile. When you step back and look at the full picture, it becomes clear that China reducing its exposure to U.S. Treasuries was never meant to be the event itself. It was a signal that the traditional financial levers used to manage economic slowdowns are losing effectiveness, and that governments are being pushed toward a different set of tools, not louder tools, not dramatic ones, physical ones. For decades, economic slowdowns were managed primarily through financial engineering. Interest rates were adjusted, liquidity was injected, confidence was guided, asset prices were supported. When those levers worked, the real economy followed. Consumption recovered, credit flowed, growth restarted. But when those tools begin to lose their force, the response changes. The system doesn't collapse immediately, it reorients. China is not unique in this regard, but it is early. Its economy is large enough, complex enough, and stressed enough that these shifts become visible sooner. When credit stops stimulating growth and rate cuts threaten currency stability, policymakers are left with fewer options. At that point, growth is no longer something you inspire. It becomes something you construct. Construction requires inputs, not narratives, not promises. Inputs. This is the lens through which silver needs to be understood, not as a speculative metal, not as a hedge, and not even primarily as a monetary asset. Silver sits in a category that markets are notoriously bad at pricing correctly. Strategic necessity that doesn't announce itself. Gold announces itself. When confidence cracks, gold moves. When trust in currencies wavers, gold responds. It is visible, psychological, and headline-friendly. Silver operates differently. Silver moves when systems are forced to function regardless of confidence. Power grids do not pause because growth slows. Data centers do not shut down because consumers pull back. Electrification does not reverse because sentiment weakens. These systems continue, and in many cases expand, precisely because growth is weak and governments need activity they can directly influence. This is where silver's role becomes unavoidable. Silver is embedded deeply into the physical layer of modern economies. It is present in energy transmission, electronics, data processing, and industrial control systems. It does not replace copper. It does not replace gold. It performs functions neither can do as efficiently at scale. That makes it difficult to substitute and impossible to eliminate without redesigning entire systems. In periods of abundance, this doesn't matter. In periods of constraint, it becomes decisive. What makes silver particularly misunderstood is that its demand profile does not behave like a typical commodity. Industrial demand does not surge dramatically in response to price signals. It grows quietly, contract by contract, project by project. It does not chase spot prices. It does not react to volatility. It secures availability. That process is almost invisible to markets focused on screens and daily charts. At the same time, silver supply is structurally inflexible. Unlike energy or base metals, silver production is largely tied to byproduct mining. It depends on the economics of other metals. New supply cannot be ramped quickly in response to higher prices. Recycling provides marginal relief but cannot scale fast enough to offset sustained industrial pull. This creates an asymmetry that is easy to ignore until it is impossible to manage. That asymmetry is what allows silver to remain mispriced for extended periods. As long as paper markets dominate price discovery and physical flows remain hidden, the illusion of abundance persists. Futures contracts trade, ETFs rebalance, volatility is absorbed. Meanwhile, physical silver quietly leaves open markets and becomes embedded in long-term systems. This is why silver often looks like it is doing nothing right up until it does something dramatic. The market is not slow to react. It is blind to the pressure building underneath. China's actions fit into this framework. Reducing Treasury exposure is not about rejecting the dollar. It is about acknowledging that financial assets alone cannot solve structural slowdowns. When growth must be constructed rather than stimulated, attention shifts from financial instruments to physical capacity. Energy, infrastructure, technology, all of which rely, in part, on silver. This does not require a grand conspiracy or a coordinated announcement. It does not require panic or collapse. It only requires prioritization. Governments do not need silver to be expensive. They need it to be available. When availability becomes the priority, price becomes secondary. And when enough participants operate under that logic, the pricing mechanism itself begins to change. This is the point most market participants miss. They wait for confirmation in price before adjusting their framework. But price is a lagging indicator in markets driven by necessity. Availability is the leading one. The moment silver shifts from something buyers want to something they must secure, its behavior changes fundamentally. This is also why silver should not be framed as a trade. Trades require timing, catalysts, and sentiment. Silver's role in this phase of the cycle is structural. It sits beneath policy decisions, beneath infrastructure spending, beneath technological expansion. It does not respond to belief. It responds to use. That distinction matters going forward. As financial tools continue to lose precision, governments will rely more heavily on physical projects to maintain stability. These projects are slower, more expensive, and harder to reverse. Once started, they create persistent demand for materials that cannot be delayed or replaced. Silver benefits from this not because it is fashionable, but because it is necessary. The risk for markets is not that silver suddenly becomes popular. Popularity is irrelevant. The risk is that the transition from abundance to constraint happens quietly and then reveals itself abruptly. When that happens, the repricing is rarely orderly. It is not driven by excitement. It is driven by urgency. This is why watching daily spot prices misses the point. Price movements tell you what traders think. They do not tell you what systems require. To understand silver's role in what comes next, attention needs to shift away from charts and toward behavior. Watch where governments allocate capital. Watch which projects continue despite slowing growth. Watch supply chains, export controls, and strategic stockpiling decisions. These signals emerge long before price reacts. When viewed through this lens, the narrative changes. China reducing Treasury exposure is not a warning about the dollar. It is an early indication that financial solutions are reaching their limits. Once that happens, economies turn toward what keeps systems running, and silver sits directly in that path. This does not mean silver must rise tomorrow. It does not mean it must explode dramatically. It means that the conditions for a structural repricing are being assembled quietly, piece by piece, without fanfare. That process can take time. But once availability becomes the dominant concern, time compresses. Gold protects wealth. Silver powers systems. and systems do not wait for permission to strain, adapt, or break.